Good afternoon and welcome. My name is Dave Welk, Managing Director of Acquisitions here at Origin Investments. I'm privileged to join you this afternoon, and I'd like to extend a special welcome to our existing investors. Apologies up front for a little shaggy haircut I've got going on here. It's like a 90s Jerry Seinfeld thing going on, so apologies. It's been a while, and I'm sure it's been a while for a lot of us on this call. Also, a little bit of forewarning, there's probably a pretty good chance that one of my kids fixed the lock in this door and jumped in and joined us on this conversation. So sorry in advance for that. But we are living in unprecedented times at the intersection of global health and an economic crisis. The market dynamics are changing rapidly, and we wanted to get together and share our thoughts on private market valuations and answer the question, is now the time to invest? The presentation will last about 60 minutes. About 35 to 40 of that will be a discussion, and then we'll follow up with a Q&A at the end. I'm joined today by my colleague, David Scherer, co-founder and principal at Origin Investments. I've had the pleasure of working alongside David for nearly a decade here at Origin. And one of the things I admire most about David is that he's a true deal junkie. He loves ripping apart and challenging the fundamentals like few I've ever seen in the industry. He has over 28 years of risk management, which provides us a unique perspective here at Origin. I've learned a great deal from him over the years. Dave, I'm looking forward to sharing with you and the group today some of our conversations that we've been having over the past few weeks here at Origin.
Thanks a lot, Dave. And I'll add, we've all heard of Zoom bombing. If you see two boys run down the stairs and across the screen, that's not a Zoom bomb. That's actually happening. I'm in our dining room at this point. I just want to add that this isn't an interview at all. It's a dialogue. I talk to Dave and the teams that he managed across the country on a daily basis. What this really is doing is providing behind the scenes look at how we make decisions. And in the process, I think we'll answer a lot of the questions you've been asking over the last week. Thank you for your questions. There's been literally dozens of questions that have come in. You'll also have the opportunity to ask questions in real time using the Q&A function. I know a lot of people on the call are very familiar with Zoom at this point. We certainly are. Ask your questions now as well. And at the end, we're going to try to answer as many as we can, both that came in prior and during the call. So without further ado, let's get started, and we're going to try to cover as much as we can.
Yeah, thanks, Dave. I think we should maybe start with a recap for those who are, maybe don't follow us as closely and are looking for some additional insights on the teaser that was in the webinar. Blast was that, we blew up our entire pipeline of deals in early March, about $250 million worth of transactions. I think it'd be helpful maybe to share some of our discussions with the group and what were we seeing then, because at the time it wasn't as clear as it is today.
So it changed so fast. My partner and I, Michael, we formed the firm in the last downturn, and I'm hoping this isn't a downturn, we'll see. But Origin started in 2007, and our first 3 years were that period. So number one, we're used to seeing changes in the market and how it affects real estate. So what we were looking at in the beginning was what's happening to the risk-free rate. The risk-free rate we measure as the 10-year yield, and obviously the whole yield curve. And we watched that go from about 1.8 in January to early February to it reached 1% in the 10 years in early March, March 7th, March 8th. Then what happened was we started seeing that show up in the risk premium spread, which means the risk-free rate versus risk loans, because a lender isn't lending risk-free. They're not lending to someone who has the backing of the U.S. government. They're lending to a real estate deal, or they're lending to a corporation with cash flows. We saw those risk spreads also start to go out because as the risk-free rate drops, lenders aren't willing to lend at a constant spread. And so we're watching that. The third thing was what happened overnight, which was a two-headed problem. The coronavirus, which is causing all the reverberations in worldwide demand and the ability of folks to pay, which is affecting risk spreads. And then you had Saudi Arabia and Russia, this happened the weekend of March 8th, essentially not agree to cut production at a time where demand is plummeting. And you watched oil go from 40 to 30, 25, 30% correction overnight. That was Monday, March 9th. My partner and I met, and we made a very quick decision that we were going to kill all deals that were in process, which is a huge decision because you're talking about 3 to 12 months of work at Origin. To put together off-market deals or development deals takes a long time, and so you're essentially killing a year's work. And Dave, I'll kick it back to you because I think that these are hard conversations. Origin both buys assets directly, but we also have joint venture partners on some of our deals, in particular our development deals. And so why don't you take us through what that means when you make a decision like that?
Yeah, I mean, as you mentioned, we were dealing with in the Texas markets. There was a double impact, and that was impacting values in real estate, or at least we believed them to be at the time, which was there was the oil shock that was occurring, and then we were coupling that with the pandemic. And we were in process. We were actually in planning stages on a development project with a best-in-class national developer, and we notified them of our concerns immediately. They listened, they respected our position, they acted quickly and minimized any further losses that we were about to incur. And importantly, they appreciated us doing the right thing. They appreciated us stepping up and to share in the loss with them. And as a result, we found out very quickly, through a failed deal, mind you, exactly who we want to partner with.
And that's how you build relationships. It's easy to get along when things are going great, but when there's tough decisions about money spent for entitlements and legal to move forward, and then the project changes really through no fault of either us or our partner in this point, but you do the right thing. And in this case, they did too. Incidentally, Dave, we found out today that we were able to get a 90-day extension on that land. And so, this world's moving so fast. Who knows how we feel in September. But it's nice to have optionality, and that was a free option. So a bit of silver lining there, and that sort of addresses one of the first questions that we had was, when you kill all those deals, are they really dead, or can they come back? And the answer is it depends. It's deal by deal. Certain deals are dead. Other deals have the opportunity to come back, but you still make a decision in time, believing that you won't have another chance, and you just have to walk away.
Yeah, and so I think one of the questions that comes up a great deal, it doesn't matter who we're speaking with, it could be brokers in the market, partners, sitting on other webinars, question that always comes about is, how long does the economy remain shut down? What is the fallout from this? And I'm sure that we'd all love to hear your opinion, and collectively our opinions at Origin, on a bullish case on maybe how quickly we can get back to work, and a bearish case on if this is protracted and lasts a lot longer and is more severe.
Yeah, I'm gonna answer this really quickly because I'm not an economist, but I'll make an analogy or metaphor here. The U.S. economy is it's knocked down, and it's having CPR right now. That CPR is essentially the Federal Reserve and Congress and the president creating fiscal stimulus. The bullish case is that after 8 weeks, 10 weeks, whenever it is that people go back to work and businesses reopen, that CPR does what it's supposed to do, which is keep you healthy enough so that you can get back up and have the same level of growth as before. That is the bullish case. And embedded in that is there's going to be essentially 0% interest rates for a long time, which is in a normalized economy fuel for asset valuations. When interest rates are zero, it's very hard to get paid to save money. I mean, you're going to get zero on your money, so you're incented to invest. That I'm sure of, that interest rates will be low for a long time. What's less clear to me is how long it's going to take to re-enter that phase where we're back at work, but it's normalized growth. My opinion, and I'll tell you what it is, I really believe that it's going to take much longer to normalize. I think businesses are going to be, until we find a cure or a vaccine or a treatment, reticent to rehire at the same rate. I think that they're going to be reticent to invest in their business. And then you have essentially 50 million Americans who are above the age of 65 who will consume less because they candidly should. I mean, they shouldn't. They're at high risk, and so that's going to bleed into the third and fourth quarter. I don't think that the stock market and real estate is fully priced in that. So there's some downside risk there. And I'll give you an example. If you think about a conference we're on right now, but a real conference you used to attend, this is happening everywhere. I mean, the college I went to is doing their graduation via conference, and so what I see happening out of this is the virtualization of the economy, which was happening anyway, is now, condensing 5 years into 3 months. And so let's go through a conference example. I used to go to some conferences and I would take an Uber to a plane flight to a hotel to the conference, then go to dinner again and repeat. And let's say all that resulted in $5,000 of consumption. Well, if I do a substitute good that is a virtual conference, that might be $100. It might be $250. And there's a multiplier on all of that consumption. When I pay the cab driver, when I pay the bartender, when I pay the hotel, there's consumption that then happens. I think it's going to take a bit longer than people think to reach that new normal that we're looking for. The only reason I sort of lay out this frame is you don't have to agree with me. I might be wrong. I readily admit that. I just think that, think about it in terms of how long you think it'll take to normalize, and then use that to make investment decisions.
Dave, that's helpful, I think, and people love to hear, I think, a shape tied to it, the recovery, right? And we're hearing a lot of V-shaped, U-shaped, Nike swoosh, check mark. I don't know, I've heard a lot of different ones, but to kind of sum that up, is that an elongated U you think that we're in store for us, or what's your opinion on a shape?
Yeah, I would say elongated U, and then we'll cover this later. Along the way, there's going to be secular moves that you need to be aware of.
So let's stay with the bearish tilt for a second here. Let's hit the question on the head. We've been asked here to ask the question and answer it. How much do you think private markets have repriced today?
Let's just jump right in. I agree. In terms of total asset valuations, and I'm going to say this is multifamily because this is what we invest in and we know the best, 5 to 10%. But that's the total asset valuation. And so in a world where you bought the asset with all equity, your loss to equity is 5 to 10%. But in a world where you use 50% debt and 50% equity, remember, equity is your first loss. So a 5 to 10% loss on the total asset is double the loss to equity. So in terms of equity losses, I would say 10 to 20% at 50% leverage. And then you as an investor have to figure out how levered your investments are. Typically, public REITs use 40 to 50% leverage, whereas some private equity firms use a little bit more, and some local operators, deal by deal investors, they might use 4 or 5 to 1 debt to equity. So if you use 90% debt and 10% equity, and you have a 10% loss on the value of the asset, your equity is gone. So it really depends on how much debt you're using, but total asset 5 to 10%. What do you think, Dave?
Yeah, I would agree, and maybe it's helpful to kind of unpack the different lenses that we use to get to that number. And where there's kind of 3 different variables that we look at, certainly more than that, but 3 themes. One of it, in-process deals that we're tracking. Another is kind of public market equivalents, and the other I'd say is cost of debt. And we take a little bit of information from each one of those segments and compile it together. And yeah, I completely agree. 5 to 10% seems like a defensible number, but it might help to maybe go into detail on each one of those segments.
For private too, and we'll get to that. We'll cover that with the publics. But why don't you cover in-process deals, because we'd be remiss if we didn't talk about your teams. Dave manages all the teams, acquisition teams at Origin. So we cover 11 cities, and each member of his team lives in their region and has relationships because they live in the places they're sourcing. And so we're hearing in real time, not just about our own deals that have either closed or haven't closed, but also about the market as a whole. So why don't you take one, and then I'll take public markets.
Yeah, I'll address in-process deals, and just to follow on to your point, Dave, we're actively tracking office and multi-activity in 11 markets that we invest in throughout the U.S. And then in addition to that, we're tracking trades that are significant on a national level. And we kind of break up the world in terms of deals that were in process, call it pre-March 9th, which was the date in which we blew up our pipeline. So we look at the world before that, and then we look at the world after March 9th. And so leading up to March 9th, we were tracking about 178 deals, which is about $9 billion in transaction volume. So still a fair amount of market activity was occurring. We were, at peak levels in the economy, peak transaction volumes. So from our universe perspective, approaching 10 billion in total volume. And then I'm going to break it down to kind of how each week unfolded and the world changed pretty rapidly, almost daily, but I'll frame it in themes of weeks. So the week of March 9th, generally speaking, in-process deals were largely closing. There was a limited fallout from equity, and most of the debt providers at that point in time were still, very much involved in the transactions. They were closing deals. There wasn't a lot of fallout or noise from lenders. Fast forward a week later, week of March 16th, now you're starting to see more investors move the sidelines. And as Dave mentioned before, we do take a lot of pride in that we were one of the first in the industry to head to the sidelines and hit the pause button. But it didn't take long for other groups to start following suit. Some jumped in later the week of March 9th, more so certainly the week of March 16th. Lenders, though, were still honoring their commitments to deals that were pretty far down along the road to closing. But then you started to see an implosion of the mortgage REITs and a few debt funds, and this was largely due to margin calls. And they're starting to hear rumblings at this point of retrades in the neighborhoods of 1 to 3%. And that was about a third of the deals that we were tracking, but the late stage deals that were close to the finish line were still largely happening. Now the week of March 23rd, despite the Fed movements from the week before, closer to 75-80% of the investors were moving to sidelines. At least some sort of pause. So a fair amount of the investors in the marketplace were putting their pencils down. Hearing more about retrades of upwards of 3 to 5%, potentially upwards of 10%. So some material moves in pricing. What you're also seeing, which you just reported out on, which was we got a contract extension on a land buy. A lot of that was happening too because the information set is still not readily available. And so a lot of buyers and sellers were thinking, well, with more time, if we extend a contract, we'll have a better idea of a normalized environment. Then buyers started beginning to walk this week of $1 million plus deposits. And lenders started changing terms a little bit, pulling back commitments on select transactions. And now, the week of March 30th, there's just a handful of deals that are still getting done, a lot of restructuring, and the vast majority of investment activity, both on the lending activity, has completely fallen out.
Dave, I might have cut out for a second. Am I back on?
Yeah, you're on.
Excellent. I would just add that some pretty sophisticated capital has been walking away from 5% hard deposits, which indicates they obviously think the market's lower than 5%, or they wouldn't take 100% certainty of loss on 5. So we're seeing that. But I'll also tell you, this changes every day. Literally today, we were trying to sell some assets and they fell out, and some of them we had hard money and we were able to, we collected that money because it was due us from the buyer. But we're hearing now that certain people are interested in purchasing some of our assets again, and we'll look into it. We also, there's a reputable national owner operator that is closing on a deal that's down 2%. And so the point is, it's still completely fluid. And if you asked me 2 days ago, I would have said, it really feels like people are walking away from 5%. And today it seems less clear. I mean, would you agree, Dave? It's so fluid.
Yeah, and a big part of this is the change in the debt markets, which is the second pillar of, of information that we're looking at, and that has changed truly day by day. And at the outset of this, there was the three big things that we were focusing on were the cost of debt was changing, the amount of debt available, meaning proceeds were getting cut, was changing, and then as a result of the two, that starts to eliminate certain buyers from the marketplace. So less buyers means less liquidity. And the debt markets, that's been really interesting over the past couple of weeks, because when right before the Fed made their announcement, you saw the GSEs, the government-sponsored entities, the agencies, if you will, Freddie Mac and Fannie Mae, their spreads, in which, by the way, they are relegated only to multifamily lending. So you can't use this program to finance a commercial asset. But the spreads blew out really quickly. I'm talking like 80 to 120 basis points overnight. And then the Fed announcement came about basically unlimited buying of agency MBS, the security pools that collateralize those underlying mortgages, and also unlimited treasury buying, and more, maybe as equally as important is corporate bond buying, which was different than the last go around. And that seemed to really quiet and almost pull back all the spread expansion that happened, seemingly in a week. So the cost of borrowing for agency is basically where it was at pre-COVID levels. Now, life companies and banks, that's not the same case. The banks are really more in a defensive position. They're making sure they're shoring up their portfolios, and they're not as actively quoting on deals. Life companies blew out spreads pretty quickly too. They've come back in, but they're not offering the same leverage proceeds that they were in the past. So, but day by day, I mean, when this first happened, everything had a 4% handle. Borrowing costs were north of 4%. And then as, the last couple of weeks, we've seen life companies and certainly agencies come in inside of 4%. So we're monitoring this, but the debt is going to be a big driver if there is disruption in this cycle, and we'll be following these opportunities.
Yeah, Dave, just to summarize, the cost of borrowing is about the same. The risk-free rate's way lower, so the spreads are out. We can go into deeper detail, but this, by the way, as a listener, ask your questions, but also provide comments. If we're using too much jargon or you're not following something, or if you want to go deeper into something, we'll have follow-up episodes where we can also handle those things. But to summarize what Dave is saying, the cost of debt has not gone out. The risk-free rate went down, the spreads went out. What's changed a lot is the amount of leverage you can get. And so it doesn't really affect Origin because we didn't use that much leverage, but a lot of our competitors did. And so if you're using 75, 80, 85, 90% leverage, oftentimes those were the highest bidders for assets too. And I believe they're going to be really impaired in their ability to buy assets because they're not competitive if they can't use a lot of leverage. Mainly because they don't have access to the amount of equity you need to capitalize something with 40% equity. So that alone might cause pressure on pricing. And so that's obviously good for future acquisitions. And we're looking forward to hopefully that market normalizing that way. But it's also something that pushes down the price of existing assets. And we'll see. That'll kind of segue into the next section, Dave, which is why do private markets take longer to reprice? But we'll cover that too. I want to briefly touch on the third leg, because what we're trying to do is provide a frame so that you can, just as you did with the economy, when I said my opinion on that, this frame will allow you to decide where you think valuations are in the private market, because there won't be trades that initiated after mid-March for another 90 days. And we'll explain why in a moment. But the third leg is the public markets as a proxy. And so there's publicly traded apartment REITs. There's publicly traded REITs actually for all real estate asset classes, and we actually cover those at Origin. We have a public portfolio manager. We're having a call on that tomorrow. But what we're seeing is those publicly traded apartment REITs, when they repriced, and they tend to reprice, they overreact in both directions. And so on the very high, they're probably priced too high, and on the very low, they're priced too low. But the low was somewhere around 35 to 40% correction. Right now, as of today, and it does change almost hourly, but I'm going to say they're 20 to 25% lower. Remember what we talked about with debt to equity. Apartment REITs are 40 to 50% debt. And so what we're doing now is dividing the correction by two. So I'm just using the same formula in the inverse. And so if you're down, let's just pick it, 22%. Then if it was not priced incorrectly to start, the actual equity, right? The total value will be half of that. So the asset level correction is 11%. And so now we're looking at a frame that kind of corroborates what we're also seeing in the private markets. 11%, we said sort of 5 to 10% using the first lens. The debt lens hasn't fully played out yet. It's moving quickly, but it's putting pressure down as well. So think about the frame and come up with your own conclusions, because you're not going to see private market volume trade for 90 days. We will update you on what we're seeing. That's part of the goal of this call. Do you have anything to add, Dave, to that?
I mean, not much, other than it's probably important to note that in the last correction in 08, 09, we saw public markets, as you alluded to, they blew out first, they blew out quickly, and they probably overshot. And then they tend to overcorrect faster too. So we're very much looking at the public market as a proxy. And there's some really good opportunities here, and we'll talk about that here in a second on where to invest at this point. But just that's one thing we're keeping in the back of our mind, is that because the multifamily public market proxy is down around 25%, doesn't necessarily mean that it's correlating directly to private market value. So just to note, there's generally a little bit more volatility in the publics than there is in the private.
Yeah, and there's also there's a premium to be paid for total control of an asset. And so you see that in the public markets. If someone tries to take a public company private, they pay more than the stock price because there's a control premium. And it's the same in the private markets. That, in fact, is why Michael and I entered real estate in the first place, is we wanted total control over the whole investment. So because we believe that we could insert better risk management and management into the investment. We didn't want to buy a share. We wanted to buy the controlling interest. And so there is a premium for that. Let's move on to perhaps why markets in the private side take so long. Dave, you want to cover that? Why do they take so long to reprice?
Yeah, I mean, there's generally a lag in pricing, right? And there's several reasons on why that happens. But right now, we're living it. The transaction market takes a long time to play out. You mentioned before, our pipeline took between 4 and 9 months to come together. It takes, generally speaking, on a normal deal, somewhere between 60 and 100 days to be completed. So when you stop the machine and you stop transaction activity, it takes a long time to get the machine back up and running again. So it's going to take us a while until we start observing, when transaction volume gets back flowing again, real data points. And those real data points will set the market at that point. And by the way, it's not going to be 1 or 2 data points that we then point to and say, well, the market's been reestablished. It's going to be a preponderance of data, a preponderance of transaction volume. And this is going to take, a couple quarters more than likely. And history has shown that the private markets generally lag their either recovery or their downturn by about 2 to 3 quarters from the public market. So it just takes a long time we're not a super liquid market, unlike the public side.
Yeah, and a couple points to add. Number one, private real estate's less volatile than public for the exact reason Dave is mentioning. And there's a lot of instances where there's noise in the public markets and it never actually even shows up in the private market. Q4 of 2018 is a great example. In this case, interest rates were actually going up. The Fed was raising rates, believe it or not. And the stock market, in particular, hard asset market, including publicly traded REITs, they really did go down in value a lot in Q4 of 18. Let's say it's 20%. The private market didn't correct at all. And then in Q1 19, the public market remade all of those losses back. and finished higher on the year by about 15%. And so tremendous volatility in the public side. And in the private side, what happened? The answer is nothing happened. Net operating income never went down. Valuations didn't reprice because there's a 60 to 90 day lag. And by that point, it had already corrected back. This is not one of those cases. That's not what I'm suggesting. I think this is an actual change in value, and I've said as much. But it's an indication that whatever it is you believe, right? If you believe that the low was put in the stock market 2 weeks ago, then what you should be doing still is buying the publicly traded REIT market because it's still depressed. And the private market won't really be able to transact for another 60, 90 days. If you believe that the market will retest the lows or go further down, obviously don't do that. But the private market doesn't have enough time in correcting markets to do that. Works in reverse too. If we start to normalize, the public market could go up much, much faster. And then you'll see a lag where the private market transactions are actually the buy. So back to 08 to 10, from 08 to 10, the good buys were in the public markets. But from 11 to 13, the good buys were in the private markets. And we can go more detail on that. Dave, let me ask you another question. It's sort of a follow-up to this one. Why is it that any owner would sell anyway when valuations are lower in the private market? Why would they do that at all?
Yeah, I think this was a question we actually received from a participant. This is a great question. And the short answer is there's several reasons. Could be forced to sell, which would be debt driven. As we're seeing now, we haven't really touched on collections. I'm sure there's a few folks that want to understand how we're seeing rents coming in now that it's April 1st and beyond. But as rent collection go down and operations erode, some of the debt covenants can be triggered, and that would then force an appraisal. If the valuation goes down, which valuations are very difficult to come by for all the reasons we talked about, there aren't a lot of data points. That's how appraisers typically look and establish values is through comps. So there may be a requirement then for the owner, the borrower, to infuse some equity. And that's called recapitalization. It's something we do here at Origin. But that's one of the primary reasons why would be really from a debt perspective. Other issues could include maybe it's a fund manager owns the asset. It's at the end of the fund life, and they maybe have one or two assets left, and they're looking to just liquidate the fund. Sometimes that's a representative of transactions in the market. Another example could be if a certain borrower needed to shore up liquidity, as an example, and they had an asset that maybe was still in the money, and they had other assets that they wanted to maintain control of to create some liquidity for themselves, they would sell an asset. And so that's one of many reasons. I'll just add this point is that back to the forced to sell because of debt, this time might be a little bit different because the lenders have been seemingly willing to work with borrowers in granting forbearance and extensions and removing foreclosures. So in the early goings of this, it looks like lenders are being accommodative.
Exactly. I mean, the short answer to that question is there are always sellers in every market for all the reasons Dave mentioned: debt maturity, debt service issues, partnership issues, fund life issues, personal issues. And when economies get stressed in a recession or a downturn or cash flow stress, those issues are heightened. And so you actually see more impetus, not less, to sell. And you'll see a tremendous amount of deal flow. It'll just come in the next quarter or two. Is it time to buy right now in the private markets? My answer is no, not at the old valuations. It's not. I think that they're down 5 to 10%, and you know my opinion on growth. But don't mistake that for Dave's team. You know, Dave's been running our acquisition team for 10 years, and we're in the market all the time. So if we come back in 6 weeks and say, well, you know, we're actually going to do this very large deal, it's a portfolio deal, et cetera, that's not inconsistent with what I'm saying. What I'm saying is there's a lot of uncertainty, and the way you get paid for uncertainty is the opportunity and the pricing of that unit of risk. And so if we find things that we think are really interesting that pay us for that risk, we'll take it. I'll take it in the next 2 weeks, 4 weeks, 8 weeks, 12 weeks. But the market as a whole won't normalize for another few quarters, in my opinion. Um, Dave, I want to answer a couple questions that we had laid out, and then we're going to transition to questions that investors have laid out. But let's start with three that I felt we should definitely cover. The first is about collections, which is critical. And Dave, why don't you ask it to me, because I probably have the most up-to-date data on this, given that I manage that team as well.
Yeah, I think this is one thing that a lot of participants in the market are very curious about, something that lenders are watching closely. And I did see a headline today that came out from, I think it was NMHC that posted their survey, but on a national level, it appears that early reports indicate about 70% collections of normalized collections occurred really the first couple days of April. And I'm not sure if that's a total tally, because rents have a tendency to come in, first or the fifth, some are late. But 70% was the headline number that I saw reported just this morning. So yeah, I'd love to hear, our own specific portfolio data.
Yeah, absolutely. And thanks for that. I hadn't seen that national data. So thus far, we're at 83% collections, and that's, first of all, that's better than what you just heard, but that's also way behind what it normally is. Normally, it's in the mid 90s to high 90s. Typically, people pay from the 1st to the 7th of a month, and obviously, today is behind that. So, and by the way, we also have quite a few requests for relief, and we want to help people. And so, if you're asking for relief and you can prove that you have a meaningful impairment, you work in the restaurant industry, like we understand that. Relief is not, it's not a forgiving debt, it's deferring debt. In this case, the debt is your lease payment. And then by the same token, we might ask the lender for not a forgiveness of debt, but relief from debt until this all works through. That's kind of how it's working in multifamily right now. So our collections are meaningfully higher than what you're saying nationally. My guess is, Dave, that's because our assets are, class A and A minus assets. And we really look at assets as what the renter, their ability and willingness to pay. So we tend to be in the highest quality locations of cities with good assets. And those tend to be the least volatile in downturns as well. So let me move on. What does the competitive landscape look like, Dave? And I guess let me frame the question a little better. In the event that there's real stress in the economy and it takes longer to normalize, so this is a protracted repricing that happens over the next 6 quarters, for example, what happens to the multifamily real estate competitive landscape?
Yeah, I think you're going to see a consolidation of firms, and this goes for all segments of real estate, not just multi, but we saw this in the last downturn. Like, I think you're going to see a consolidation of firms that have poor risk management, processes in place. They're probably over levered, as we talked about before, and the challenges that leverage brings, and not only at the property level, but potentially at the company level. So there could be some balance sheet issues and some cash shortages that don't allow for the business to continue to operate as a going concern. And some of the multi-operators, they may have had a strategy where they went in late cycle and were buying up B and C assets at fully priced values. And to your point, I think why we are actually showing higher collections than maybe the national number is because we believe internally that properties that are maybe the gray collar type workforce housing projects, they have a demographic that's going to be most severely impacted by this. So if you were a late cycle investor in BC product at full valuations, and the cap rate spreads, by the way, between A, B, and C over the past 7 years to 8 years have been slowly and gradually converging on one another. I mean, there's still a spread certainly between A, B, and C, but the margin has compressed substantially. So I think you're going to see massive consolidation at the investor level.
Yeah, that's a good point. Let's move on to the questions that the the listeners sent in, and I think we retained about 20 to 25 of them. We're going to do something for the last. I look like we have 20 minutes left. So we have a new. Well, this whole show is new. Webinar is new, but we're going to call this Origin Take 5. And what that means is we'll alternate questions. And if Dave asks the question, I have 5 to 15 seconds to answer it, no more. So please hold us to that. Origin Take 5. So Dave, I'll ask the first question. You have 5 to 15 seconds to answer, and then ask me the next, and we'll just keep going. All right?
Are you sure you can do 5 to 15 seconds?
I'm going to try. I'm going to try. And by the way, this is a great opportunity for those listening. If you like this idea, let us know. And if you don't, let us know. We can always answer questions in minute format. The reason I like 5 to 15 is it forces you to answer the question directly and not equivocate. People want straight answers. We'll try to do that. All right, Dave. How is Origin handling renters who claim financial hardship during the pandemic? I think I just answered that, so that's an easy one. Go ahead.
Yeah, I mean, you did. We're handling it on a multitude of levels. I mean, most importantly, what we're doing is we're requesting that they provide evidence of hardship, a note or letter from their employer. But we're being flexible and working with renters, the short answer.
I think that was good timing. Go ahead.
All right. So I'll stay with, we'll go to deals here for a second. And the question was, you walked away from some deals. How did that cost? I think how much did that cost? And when do you expect to walk back to them?
It'll depend on the deal. Certain deals will come back, certain won't. In terms of hard costs, 100 to 200,000 was our total loss. But that doesn't factor in staff time. And when you factor in staff time, it gets to be much, much higher. Okay, my turn. In terms of acquisitions of real estate, as your team, this is appropriate. You are the team leader. Identify any tax changes in the recent flurry coming out of DC. I can answer that, Dave, if you want.
I was going to say, why don't you go ahead and take that? Yeah.
Okay. So the short answer is no, not out of this one. Obviously, QOZ was born out of the tax law. That was a few years ago. Out of this one, they did extend depreciation, but that's only for active ownership. So we're looking into it, but the short answer is I don't think so for limited investment partners. And I think that would be more of the appropriate answer. Your turn.
Here, I'll answer this one. If a distressed asset becomes available for sale in the market, would Origin be a player in pursuing the purchase of it, or will Origin be in a wait and see holding pattern? Short answer is depends on price. And when you talked about that earlier, I mean, we're looking for additional data points in the market, but if we see something that is protected from a capital position, and protects it from value decreases further, the high expected value, we'll pursue.
And we have a lot of experience doing that, by the way. The 08, 11, 12 period, I mean, that's really all we did. Bankruptcies, short sales, restructurings. We do very well in that environment. I don't want that to be the environment. No one does, including us. But if that's where it's going to go, we do well there. Question for me, do you see the crisis as transformational for the office sector? If so, why? I don't see it as transformational, but I see that the last unit of demand, which helps to drive asset valuation, will be lower. There will be a substitute good. We're actually doing it right now. People are learning how to work virtually. And so I see long-term office demand as being incrementally lower. Go ahead, Dave.
That was as succinct as I've ever heard you answer your displeasure for office. All right, I'll jump in on, let's see here. Interested in your thoughts on secondary markets such as ski areas. Will there be a time to buy there? Interesting question. We don't really invest in places that have singular demand drivers like ski areas. It'd be an interesting study to see how well like Aspen held values in the downturn. I mean, generally that segment is well-heeled, but we're disciplined in our target markets and looking for mispricing.
What is your outlook on the single-family home for rent market? This asset has performed quite well. Do you see this as a trend moving forward? I like that market, and I like it moving forward. I actually think that recessions put stress on the ability for people to buy and qualify for mortgages, and they need to rent for longer, and a lot of them want to have the home ownership experience. So I think that market should do well from a demand standpoint. The ability of people to pay higher rents is another variable to look at, but I think they'll want to be there.
All right. So what is the outlook on this? What is the outlook for multifamily apartments, and what is the downside risk in value in this current environment? I feel like we covered this one pretty thoroughly, but short term, the risk there is collections and potentially issues falling out from debt as a result. Long term, it's a necessity asset, and we think that there's real long-term value in multi.
Yeah. And that also, Dave, we haven't spent a lot of time talking about cap rates and how they really are the determinant of long-term value. If you think something's going to be disrupted in cash flow for a few months, that's not a big deal. The value of an asset is the net present value of all cash flows terminal. But when you start talking about changes over time, like I said to you, and I think rent growth will be slower for the next 5 years, that hurts the asset valuation a lot, and that would be embedded in the cap rate. My turn. How do we rank the risks of the varied U.S. residential subsectors: workforce housing, higher end, urban core, student housing, senior housing? Well, I'll start from the bottom up. Senior housing, just from a headline risk standpoint alone, has been hit so much, and we all know why. And the stocks, great stocks like Ventas, which have, it's a healthcare company, but it's also a senior housing company. They were down as much as 60%. Now they're down 50% still. So obviously that's a struggling asset class. Student housing also, I would be reticent to be getting into student housing. I think that there's going to be more online learning. It was going to happen anyway, but this is putting a lot of gasoline on that trend. I would be very careful about that. Remember, in student housing, you're at highest and best use. You're charging by the bed. And so if you have to adapt it as multi, that's less revenue. Higher end urban core, that's what we're in. We like it. We like it going forward. And workforce housing, I like it overall. We're not in it, but I think that it's going to be more disrupted and less cash flows in this particular stressed environment. I know that I took too long, Dave, but that was really 4 questions.
No, I know. That was well done. All right. What kinds of deals make sense to buy right now because they will weather the downturn? Deals, I kind of talked about this earlier before, deals in a protected position in the capital stack, offering higher expected value. I'll give you an example. We're able to buy a note or some debt at a good valuation. That's something we'd be interested in. And I'm just going to leave with public REITs. We talked about it, data centers, cell towers, industrial. Those all feel like a good value right now, and they'll be protected.
And we'll cover that tomorrow on the public call. I encourage you. The tower, publicly traded REIT stocks, they're not lower at all. And so you have to, in investment, both look at the expected growth rate. That's what we don't know. That's what we're trying to find out. But we do know the price, and we do know the PE ratio. So the PE ratio and price of data centers and towers is quite high. They haven't gone down, but so is their expected growth rate. And so you have to look at the whole. It shouldn't be a surprise that as the virtualization of the economy gets higher and higher and higher and faster, there's more and more money moving into that space, and that's what those REITs are. They're cash flows from virtual revenue. I'm going to skip down a little bit. Here's a good one about debt. With interest rates this low, is there a benefit to locking in a longer-term fixed loan rather than a variable? The answer is it depends. Your loan does not dictate the business plan. The business plan does. And so the problem with fixed rate loans is they're not malleable. They come with defeasance and yield maintenance. And so if you have an asset with varying cash flows, you need to have a variable rate loan too, because it's very changeable. Um, Probably something we should cover, not in a lightning round. This is a whole show.
How are we doing on time, by the way?
We have 7 minutes. Why don't we just start at the top? You can ask the first one. Leave the name, obviously private.
Yeah, let me try and drive as a inexperienced webinar moderator here. Okay, we'll start at the top. When you blew up your pipeline, did you drop any deals or just walk away from the offering table?
Can you hear me, by the way?
Yeah.
Excellent.
Yep. Just came back.
We sort of answered that. We dropped every deal. Some of these deals might come back, but they were actually dropped.
We've got some international callers, interesting, asking us our thoughts on German and Italian markets.
Yeah,
I don't think we're quite.
Can't help you.
Yeah, unfortunately, we're not sophisticated enough to, or well versed enough in those markets to address those questions.
So, do you want to ask all the questions? Go ahead, Dave. Whatever you want to ask.
Yeah. So here's a good one. I think, were there certain metrics or indicators that drove you to start investing post 2008?
Yeah, the discount rates were so high that they incented you to get involved, right? So what I mean by discount rate is in 2008, the entire equity market broke down because there was no access to debt. The lenders were gone. It was bank driven. And so your discount rate became the discount rate of equity. And what I really mean by saying that is you went from a, let's call it an 8 or 9 discount rate to now we could use 20 to 25 and still get deals done. And so when the expected values are that big, you're incented to do things.
Here's a easy one, quick one. What's your typical leverage point?
60 to 70%. When I say that, that's debt. So that would be 30 to 40% equity.
I know you kind of briefly touched on cap rates earlier. Question was, can you translate a 5 to 10% drop in asset value to a change in cap rates? A hard one to do, but
yeah, that's a whole show. But without getting too nuanced, yes, you can. One function of the cap rate is it's the multiplier on net operating income. So you can do it. The problem right now is we also don't know what net operating income is going to wind up being, right? We know the cash flows are going to be disrupted in the short run. But when I was talking earlier about how long the economy takes to normalize, I also am concerned that you're going to wind up with slower growth rates on earnings, including multifamily earnings. That's rent collections. So you might wind up with a lower numerator as well, a lower net operating income. So let's do a show on that as well. But the short answer is yes, you can do it, but there's a lot of variables and assumptions embedded.
Just reading through a couple of other comments, maybe we can talk about, we reported some pretty good numbers on collections for this month. What do you see happening in more like in May and June? Is this going to get worse? Are we going to see a fall off from here?
Short answer, I do think it'll get worse in May and June, not better. I think people have savings and they're using them. The big X factor and mitigant is how much fiscal stimulus will mitigate that and when will it arrive. So if you're going to get any form of government assistance, does it get there in a timely way? Because if it doesn't really help you in 4 weeks if it shows up in 10 weeks. In a perfect world, it isn't very disrupted. I don't think the world will be perfect.
All right, I'm trying to find maybe one more that we haven't really addressed. Where does Origin see the greatest opportunity over the next 2 to 5 years? Value add, stabilized, new construction, specific locations.
Well, locations, we believe in the cities we're in, right? So I would say growth markets like Denver, like Phoenix, like Texas, the Southeast, Nashville. Florida. We like these markets. That's why we're there. We have offices there. In terms of the strategy, one of the things we haven't talked any about yet is construction and development. And so there's going to be a lot of opportunity in development because if this is protracted, even protracted in the sense that it's 6 to 12 months, the construction trades start to run out of work and their pricing comes down a lot. And so our economy was really kind of roaring in Q1, and the construction prices were going up and had been really for the last 4 or 5 years. And so you could enter a world where you're building into a strengthening economy at construction pricing that's very low. And that's how you really do well in development.
I think we're at time here, Dave.
Well, I think with the lightning round, we got through a lot. Obviously, there's 88 questions not answered. So thank you all for your questions, number one. We'll review them. We would appreciate if you have comments to also send them. Anything that you think could improve the session, or if you want to have another session, there's going to be a lot of new data because there is on a daily basis. And we're committed at Origin to be transparent, and whether you're an investor or not, educate people about what we're seeing, because there's nothing that we know that makes us so smart. We're not, but we are at the confluence of a lot of different information streams, and we want to share it with you. So thanks for your time, and hopefully we'll see you all soon. Be safe.